Today, I'm joined by Gervais Williams, Fund Manager of the Diverse Income Investment Trust. The investment trust invests across large, mid and small cap companies, including those listed on the AIM market. Gervais, what's the current split and what are the main things that you look for to assess the sustainability of a dividend?
The kind of companies we select for really are companies which are investing hard, generating cash returns like investment, and as that cash comes through, you tend to get a surplus of cash, which then obviously drives the dividend growth. So most particularly, we're looking for companies where we think the investment is going to generate very productive commercial returns. Cash is very important to us, and most particularly companies which are right across the market cap range. So to come back to your initial question, it has about just over a third in the AIM market. These are some small and mid-sized companies, but it also includes obviously many in the mainstream markets. So around 23-24% perhaps in the FTSE 100, something like 18% in the mid-cap index, and about 18% in the small cap index.
Has the amount of income that's been generated by the underlying investments returned to the level it was prior to the pandemic this year?
Yes, I mean, if you look at the overall stock exchange, quite a lot of companies have cut their dividends and they haven't recovered as fully. Then that's some of the oil companies, some of the banks, etc. And so actually income across the stock exchange generally, the London Stock Exchange, is around down. It's down about 20% according to the Link dividend monitor. The income from the fund actually has recovered in revenue per share for the year through to May 21. It's very close to where it was in May 2019. So we've seen the fund actually navigate the period of dividend cuts more successfully than many others, and we'd like to see, obviously, going forward, hopefully the income to grow from here.
2021 has been a good year overall for investors in UK equity funds and investment trusts. Has it been the smaller companies that have driven the performance of Diverse Income Trust this year? And could you pick out a couple of companies that performed well?
Yeah, I mean, it has been quite an interesting year because although small companies actually performed pretty strongly last year, actually, 2020. Many of the companies in which we're invested in aren't as cyclical. They're more driven by structural growth trends, so they actually tend to hold up quite well during global recessions. And we've seen small companies continue to succeed in the early part of this year, but more latterly, we've seen quite a lot of fundraisings, which, if anything, have held back. There's been a bit of market indigestion, and most recently, with a quite strong dollar versus the UK pound, that's actually led the FTSE 100 actually to lead the market up in the last sort of part of this year. So it's been a mixed year this year. In terms of some of the better returns, I mean, we've had some very strong individual stocks, but actually the fund itself invests across about 140 individual holdings. So it's not really down to one or two holdings. It's actually down to a collection of many holdings, which have led to the strong performance of the fund over the last few years.
And I wanted to move on to recent portfolio activity. What have been your latest buys and sells over the past couple of months?
Well, we've had a number of bids over recent months. We had a big holding in Morrison's, the supermarket chain. Charles Stanley is another company which has just been taken over. So we've had some companies which have left the portfolio for those reasons. In terms of new opportunities, in fact, although markets generally are moving to new highs, and certainly many of the most popular stocks have moved to very high valuations, many of the more regular stocks perhaps remain very overlooked, and that's very true, we would argue, for the UK stock market specifically. So a good example of that might be Mears Group, which is a business which is involved in helping local authorities and particularly housing associations deal with repairs. You know, if you've got a leaking roof or perhaps some damp proofing needed, they're very good at doing that. They've got very high levels of service. They've been doing less work, which is just can be deferred. So the volumes of work have been a little less busy during the COVID because people haven't wanted workmen coming in during the COVID period, but that's now recovering. But the share price is incredibly overlooked. It's generating a nice yield, a bit over 4, and we expect that to move up in the next couple of years. Again, completely overlooked company, excellent customer service, ultimately very well positioned for recovery, and we're pretty excited about that at the moment. Perhaps another example is a company which is more nascent. In other words, it's a sort of turnaround job, Lamprell, which is a company which has been quoted really for the last 15 years. At one stage, it was capitalized at 1.2 billion market cap. It tends to build oil rigs in the Middle East. Obviously, over the last 10 years or so, oil rig demand's been less. They've struggled a bit. The market capitalization has fallen to a tenth of where it was, 120 million. But they've got a lot more opportunities now to build wind turbines, offshore wind turbines, and they've got the potential for taking quite a large number of orders. They raised capital recently to fund many of those new orders, and we've got involved. No dividend at the moment, but most particularly a company which could generate very substantial profits and dividends and cash in the next few years, which hopefully will grow dividends in future.
The trust has some exposure to young companies that typically operate in immature industry sectors. Could you name a couple of examples?
Yeah, I mean, a good example of that might be iEnergizer. It's incredible. A company like that, which is a relatively large capitalization, it's over 500 million market cap, but it's very, very lightly covered. Very few analysts cover it. This is a company which is involved in helping companies look after customers. It's very good at customer service. It does quite a lot in regulation. So if you need to check to see whether your employees are actually up to date in terms of anti-money laundering and that kind of thing, it's grown extremely well over recent years. It's paid very generous dividends. It's a sector which is very immature in that it's growing quite fast because people used to do a lot of this in-house and they're doing it more out of house. It operates out of India where it has a relatively low cost base. Again, a very overlooked stock for a relatively large business. Incredible. Another example might be actually a mainstream company, Drax. Now you might say, well, hang on a minute, Drax has been around forever and it's got its big power station. It certainly has, but it's actually moved into the biomass business. We think it's leading the world in its opportunity. It's just had its capital markets day where it says the opportunity isn't so much in the UK, but using the same technology across the world. Again, a very immature market with climate change. We expect very strong demand in that area.
In August, it was revealed in the Trust's annual report that you purchased some insurance to help protect the portfolio in the event of a market sell-off. Under the put option, the Trust will profit if the FTSE 100 index falls below 6,200 points from now until December 2022. Do you think then that it's likely that there's going to be a significant sell-off?
Well, not really. I mean, what we think is that actually most of the time markets go up. And we like that because a large part of the portfolio participates as the market goes up. But we also know that markets are volatile. And certainly after long periods of recovery, sometimes there can be aspects which lead to a setback. So it's a bit like a car insurance, really. When you go out in your car, you don't think you're going to have an accident, but it's sometimes useful to have the car insurance there ready for the adverse event. Clearly, what happened in 2020 was that we had the pandemic. The UK stock market did fall very considerably at that stage, and it's not so much that the put option provides a cushion. It goes up as the market goes down. It helps the underlying assets be more resilient at a time of a setback, but most particularly you can then take profits on that position, bring cash into the portfolio and buy more income shares at a time when the market prices are depressed and participate in greater scale on the upside. And that's what happened in 2020. We're not saying we know that's going to happen in the next 12 months or so. We just think that the cost of insurance is relatively low. The markets are relatively high, and we just don't know quite what's going to happen. And we think a bit of insurance is well worth having.
Gervais, thank you for your time today.
Thank you very much, Carl.